with overseeing the behavior, the soul, and the culture of employees in an organization. And how are they going to do this? By ensuring that there are frameworks developed that speak to integrity and values. They are going to ask CEOs to develop or acquire such frameworks and report to the board that every single individual has been trained, spoken to, or acknowledged the behaviors that must be followed in conducting the work of an organization. There is no risk greater than reputation risk. So when I was talking about risk management just now, we might have been talking about physical risks, we might have been talking about fires, etc., money risks, etc. But most importantly, reputation risks. An employee can destroy the image of your company because his personal value system or the control environment allowed certain behaviors that the board would have been totally against in terms of the policies established. So what in that organization block is that the CEO must ensure that controls are instituted on an ongoing basis because of immersion of employees into behaviors that speak to integrity, honesty, values, and concern for the reputation of the organization. Let me tell you what that does and how it affects the profit line. What it means is that you have inside your organization inherent systems of control. You don't have a system whereby what you have is people behave in a certain way, and then you have another department of internal auditors or ethical auditors, and they come in and check whether people are behaving. No, that can't work. It's too expensive. Right? So management must give assurance that preventive controls in the areas of integrity are in place. Next point, management assurance. Management assurance now is where the board requests, and it's done on a formal basis, a specific review or intervention that assures the board that the entire control policies have been put in place. And independent assurance now relates to the work done by internal auditors or external auditors, that all the policies, the financial controls, the risk management controls are functioning as intended. So as a board member, therefore, you would be assured that in terms of information being provided to you, and this is the whole aspect of your role of governance, to ensure that the organization implements governance processes that give you feedback on the appropriateness of actual behavior as against behavior that you have enunciated in your policies. You needn't cross the line. Basic risk management model. I'm not going to spend too much time on that. You identify the risk, assess the risk, identify the control measures which must be embedded in business processes, assess them, implement solutions, monitor performance. That's like the management assurance. And this is a continuous cycle that is worked on day in, day out. As I head towards the end of this presentation, I'm talking about, I'm going to ask Gail Rampersad to send you, by the way, the link to the Open Compliance and Ethics group, and you can download, free of charge, a significant document, maybe 200 to 300 pages, that sets out in detail governance, risk, and management compliance processes. And I think for another for $200 US, you can now get a premium membership that is well worth it for a state enterprise, where it sets out and illustrates in detail the flows of how you embed governance, risk, and compliance processes into your business processes. Gail, could you please remind me on that? This is now all about culture. Culture in the sense that leadership must set the tone at the top and provide consistent and repeated commitment to integrity in both words and deeds. As I say, individuals must be convinced that leadership is genuine about the commitment and values, or they will not have any regard for the established values. I mean, that is really critical. People's behaviors are driven by their beliefs. If their top-level role models do not execute on what they espoused, they will not develop the beliefs that the organization is really serious about this. And I end with this last slide. It's a pity that you might not see it clearly, but this is what the slide attempts to portray. Again, this is from the OECD. It's called Principal Performance. At the top, the words read, the mandated boundary. The boundary established by external forces, this is like laws, regulations, etc., mandates. These are the laws and the legislative framework in which an organization must function. At the bottom, it says voluntary boundary, the boundary defined by management, the board, organizational values, and other obligations. So you have those two boundaries, and in the middle you have the business model of the organization, strategy, people, processes, technology, infrastructure, etc. You look at the opportunities or threats in the marketplace, you establish your objectives. But here is the message of this slide, that a board and its management must learn to operate and compete successfully within those two boundaries. The voluntary boundary is a boundary established by the values of the organization. Do you realize that if a law or legislation was updated, do you realize that organizations could behave unethically, but yet be within the law? We don't want your organization to succeed by behavior that, quote unquote, is in fact legal, but unethical. And that situation would exist where the mandated boundary of laws exist, but the internal voluntary boundaries of reputation, integrity, trust, and values does not exist. And it is going to be a critical challenge for boards in the future to put in place those integrity frameworks, reporting, relationships, and training to ensure that they could sleep at night concerning the reputation of the organization and making sure we contribute to the government's revenue targets, which are needed to fund other programs, other social services, etc. And that is the significance of the performance of state enterprises. By your performing better, transfers from the Treasury are reduced, better returns on projects are realized, and the country and nation as a whole is able to fund its collective services that is needed at these challenging times. So with that, I thank you, ladies and gentlemen.
Thank you again, Mr. Marshall. Well, ladies and gentlemen, that brings us to an end of the first session of our program here this morning. At this point, I would like to thank the Honorable Minister of Finance, Winston Dukran, for his contribution, and also the members of the media who will be leaving us at this point. Thanks for your participation. We will now adjourn for a 15-minute break and return thereafter. Thank you.
For the depositors, but both of this
Is there any plan to maybe revise the MOU, revisit the MOU, revise it, or change it in any way that was signed between CL Financial and the government?
Well, within the context of the agreed MOU, we will be advancing the claim of the government to CL Financial.
Okay. One other thing I wanted to ask you, at least at this point, the 5% wage cap, which the unions are demanding that be scrapped before they even talk, or the whole prelude to a strike and so on. What's the government's position on that, on this call for them to the removal of the 5% wage cap?
Well, first of all, we look at the wage negotiations in the context of the compensation package,
right?
Where the salary component of that is one component, but there are other components in the salary package that includes allowances and includes what is called the living wage and other issues. And that, therefore, has to be defined in the context of the compensation package. In the compensation package, we have agreed to the tradition of consolidating COLA into the calculation of the future wages. And incidentally, this is for a period 2008-2010. So what we are negotiating here is what ought to have been negotiated a long time ago. When we do that with respect to some of the statutory bodies, there will be an automatic increase of the order of between 13 to 20%. So therefore it is somewhat disingenuous to talk about a 5% cap in that circumstances.
But in terms of the maintenance of industrial peace, I mean, and the union's threat of a strike if this cap isn't removed, I mean, does this concern you or the government as a whole about your own efforts to try to get the economy strengthened and so on?
Of course, we need industrial peace, and we will take all steps that are required to bring about industrial peace. And whatever is available in the government to do so, we will.
But how do you see it affecting investment climate now, since Ansel Roger is threatening, he's saying that they will shut down the country? How would that affect investments, and especially since the economy is now starting to pick up and all?
Well, you're right, the economy is now beginning to pick up, and it will probably bring a damper on some people, but I don't think it will fundamentally affect the decisions of investors at this point.
I have one last question for you, Minister Dugran. The chairman of ETEC, John Ramcharita, said that they are short of $150 million to complete the Vanguard Hotel on time for November 1st. And if they don't get that within the next 2 weeks, there's no way they can open by November 1st. What's your...
Well, government has taken a decision to raise those funds from the financial sector, and it is being done.
So how soon should they get it?
I don't know the details of the negotiations between the central bank, Ministry of Finance, and the financial sector, but I know it has been given high priority. It should be short.
Thank you very much. He
Thank
has
you
to
very
run
much.
to ICAT tonight.
After several years working with the government of Trinidad and Tobago. Prior to joining Ministry of Finance, Gail was senior economist of trade and industry. In her role as director, hello? You hearing me? You hear me back? Melissa, you hear me? Okay, fine. Okay. As I was saying, in her role as Director's Research, Gail's focus has been assisted in monitoring and oversight of state enterprise on behalf of the Minister of Finance, Corporation Seoul, through improved systems and procedures. Ms. Rampersad is the holder of a bachelor's, master's, and MBA, and her presentation this evening will be on will be on State Enterprise Performance Monitoring Manual. I now invite Ms. Rampersad to the podium. Thank you.
Members of the head table, permanent secretaries and staff of the Ministry of Finance, of state enterprises, distinguished guests, ladies and gentlemen. It's my pleasant task this morning to enlighten you about the state enterprises performance monitoring system. I would go through with you a bit about the state enterprise sector, the rationale for the State Enterprise Performance Monitoring System, the State Enterprises Performance Monitoring Manual, which Philip mentioned this morning, and which is, this represents a revised version of any previous ones that we had before. The standard procurement procedures, which we have already also revised based on feedback from state enterprises, our key stakeholders, and the state agency's performance monitoring information system, which is an electronic integrated system to capture the information that we require in monitoring state enterprises. The state enterprise sector, it comprises 43 wholly owned, 7 majority owned, 3 minority owned, and 27 companies held indirectly as subsidiaries. They were incorporated under the Companies Act, Chapter 8101. They are accountable to the Minister of Finance as corporation sole, and the Minister of Finance is responsible for the overall policy direction and financial policy, appointment and removal of boards of directors, establishing new enterprises, and winding up those that are no longer required. The authority of the Minister of Finance as corporation sole. In accordance with the Incorporation Act number 5 of 1973, Chapter 6903, the Minister of Finance, corporation sole, has power, with the permission of the President, to acquire, purchase, take, hold, and enjoy movable and immovable property of every description, and to convey, assign, surrender, and yield up, mortgage, demise, reassign, transfer, or otherwise dispose of or deal with any movable and immovable property vested in the corporation upon such terms as the corporation sees fit. May also accept surrenders, assignments, or reconveyances, and to exchange any property and to enter into contracts. So this is the authority of the Minister of Finance as corporation sole. Now, what is the rationale for the state enterprise performance monitoring system? We expect to manage risks. It will help us to manage fiscal risks and achieve sustainable development through good governance. It will help improve the corporate governance monitoring framework. It will provide standard formats to enhance reporting. It will enhance efficiency and effectiveness of the sector, the state enterprise sector. And to give you an idea of the significance of the sector, which was spoken about by the minister this morning, as at December 10, 2010, the sector managed total assets of approximately 120 billion. Okay, you all would have been, this morning we circulated a copy of the State Enterprises Performance Monitoring Manual. That is part of the whole system. This document is divided into 5 sections. Section 1 deals with general operating framework. Section 2, the reporting relationships and functions. Section 3, guidelines and performance monitoring. Section 4, oversight and compliance. Section 5, mechanisms for generating synergies. And I'm highlighting Appendix B, which are the revised standard procurement procedures. Now in Section 3, the general operating framework, this section outlines the framework under which state enterprises operate and the rationale for the state's involvement in these enterprises. It also makes reference to the documents for providing guidance to state enterprises and the monitoring mechanisms. Section 2, reporting relationships and functions. This section outlines the functions of the monitoring agents who must interact with state enterprises, and it includes the role and functions of the Minister of Finance as corporation sole, the investment divisions who monitor state enterprises on behalf of the corporation sole, the line ministries and the client ministries. There's a difference. The board of directors, including the audit committee and the finance and investment committee, and the chief executive officer. Section 3 provides guidelines. This section provides guidelines on the appointment, removal, and resignation of board directors. That was very important at this time when we had a change in administration and people wanted to know what was the procedure for appointing new boards. Guidelines, it provides guidance on annual general meetings, appointment and removal of an auditor. How do you go about changing the bylaws of the company? The procurement procedures, including e-auction, and later in this session, Mr. Leslie Fugaro would enlighten you a bit about what's happening in that area, including e-procurement, the dividend policy, guidelines on board fees and allowances. We seem to have a lot of queries in this area. These board fees and allowances are revised every 5 years. The guidelines on use of cellular phones and laptop computers, about payment of bonuses, new investments in assets, securities, long-term debt, and contracts that are significant relative to the company. How do you deal with interagency debt? Guidelines on litigation proceedings, and in publishing financial statements. Section 3 also deals with the statutory compliance. It provides details on the following: payment of royalties and taxes, integrity in public life. This morning we have a representative from the Integrity Commission who would deal a bit on that. But at Appendix D, we have published the law, we have put it as an appendix, the Integrity in Public Life Act, because of the importance. Occupational safety and health, and environmental management. Section 3, we have also provided guidelines in performance monitoring. We provided details on strategic plans, and this morning you heard a bit from Mr. Marshall on outcome-focused strategic planning. We have included it as an appendix. We have provided guidelines on that. Annual operating budgets. Now this time is budget time, and if you are a state enterprise that receives subventions from government, we expect that you would have already submitted your estimates for the year, for the new fiscal year. For those that do not receive subventions, you send it, well, 1 year before the period. Project management protocol, and Mr. Nurse here will provide you with more details on this. Risk management. Philip this morning, he spoke a bit on risk management and the importance of risk management to state enterprises. We have provided an appendix on risk management, the various risks that must be taken into account. Audited financial statements, which are subsequently laid in Parliament, administrative reports, which are to be submitted to your line ministry and are also laid in Parliament. This is part of reporting to the public on your operations. Board minutes, the monitoring indicators, and monitoring process flow. Now, if you turn to page 33 in your manual, this represents all the information that we expect to receive or that you expect to provide to assist in monitoring. Strategic plan, I spoke about that earlier. Annual budget, mentioned that earlier. I won't go through all, but also cash flow, that's an important, a very important one. We normally require that you send the cash statement of operations 3 weeks after the end of the month. Later I'll detail to you the importance of the cash statement of operations, quarterly returns report, and reports to assist in auditing, the internal audit report and the returns of award of contracts. This page details how often we require these reports and who are the receiving agencies and the response date. Section 4, oversight and compliance. This section details how the investment division uses the information collected from state enterprises in monitoring and evaluation, in reporting. Now, the cash statement of operations, after we get the reports from you, they are entered in manually, actually, at this stage. We enter in manually, and the system collates it, and we produce reports. Now, these reports are used internally by the other divisions in the Ministry of Finance, such as the Economic Management Division, which need information on the cash statement of the state enterprises, but they're also used by external agencies. For example, the IMF and the rating agencies. Now, these rating agencies prepare reports, country reports, and foreign investors use these reports in making a decision on whether they want to invest in a country. So you get from that an idea of the importance of these reports. Loan overdraft. We ask you to submit information on your loan and overdraft portfolios. Now we are also extending this report to include information on your investments in securities and litigation proceedings. At a time like this, when many countries in Europe, in America, and a few countries in the Caribbean are suffering from loan and debt repayments problem, you could understand the importance of getting this data. This assists us in managing, in our macroeconomic management of the economy. If a country is unable to pay its debt, it doesn't augur well for investments. Also, if we decide we want to raise a foreign loan, if it shows that we are managing the economy best, we benefit by lower interest rates. So we need this information. We not only collect information on your government guaranteed loans, we also collect information on unsecured loans. And the IMF and the rating agencies, they use these reports in providing statements to the international community of investors on the country. We also extract information from your balance sheet and income statement, and we maintain a database on your performance financial indicators. Quarterly returns reports. We also maintain a database on this information. It provides us with socioeconomic information on the state enterprises, for example, the numbers employed and so forth. Revenue and expenditure. Now we prepare these reports. This is revenue based on dividends and taxes, dividends and the expenditures that's based on subventions from government. We prepare these reports and they are used by other divisions in the Ministry of Finance, for example, the Treasury Division, the Auditor General Division, the Budget Division, the Economic Management Division. They use these reports in accounting for how money is spent. And it's part of the whole budgetary process. All these reports, this SIP, for example, the Supplementary Public Sector Investment Program, this is a report on projects being implemented by state agencies based on their own funding from retained earnings as well as their own borrowings. And this data, this report is part of the budgetary package that could be downloaded on, from the ministry's website. This will be part of the budgetary package that each year are available to the public to see what's happening in the state enterprises. Now, compliance. This section deals with what we would do to enhance compliance in submitting the various reports and the various legislation that is available to the minister to assist in enhancing compliance. Section 5, mechanisms for generating synergies. This section provides a database of goods and services produced and available and consultancies offered by each state enterprise. And the objective is to enable you all to share resources, to develop strategic linkages, to provide synergies in the sector, to encourage greater efficiency, and to increase productivity. So with the database is there as an appendix. So with this data, you may decide you may want to enter into a joint venture. One state enterprise may want to enter into a joint venture with another state enterprise. The information is there. It will allow for greater synergies in the sector. Appendix B, we have also amended and revised the standard procurement procedures to foster greater transparency, accountability, and value for money in the state sector procurement process. And it links with the relevant legislation and regulation, including the Proceeds of Crime Act 2000 and the 2010 amendment, the Integrity in Public Life Act 2000 and the 2009 amendment, and the monitoring manual. So we got a lot of feedback from you all that the previous procedures, it wasn't comprehensive enough, so we went through the process of revising it to meet the needs and to provide better guidance to you in the procurement procedures. A bit about the state agency's performance monitoring information system. We recently got approval from Cabinet to implement this system. It is an electronic integrated information system to be used in monitoring the performance of state agencies, and it will assist us to improve the state agencies' reporting and compliance. It will provide key stakeholders with real-time information, and it will assist with the decision-making process. At this time, we get a few reports from you all. We get a lot of the reports. You may email it to us, or we may get hard copies. Then we have an officer entering it manually into our database. So this SAPMIS project will assist you in entering the data from your end in your computer, and we will get it in real time, and the system will collate it electronically and produce the report. So we're using the technology to improve the system of receiving information from you all. And of course, you will have access to your information. If you want to change your records and so forth, you will have access to the information that you have entered and so forth. And we will be able to communicate with you electronically. If for some reason a report is outstanding, it will throw up a red flag and say, this report is due and is now outstanding. So it would assist us in enhancing compliance and also reporting. So I've just went through a bit about the sector with you, the rationale for the State Enterprises Performance Monitoring System, a bit about the manual which you have received, which has been circulated this morning, and which is the revised and the most up-to-date version of the manual for providing guidance. I did a bit on the standard procurement procedures, which we have also revised, and about our SAPMIS project, which we will be coming to you on to make sure that your system is compatible to allow us to receive this information from you. And our IT personnel will be in contact with you in the new fiscal year as part of implementing our SAPMIS project. So I want to thank you this morning for your attention, and we will be having our question and answer session at the end. So at this point, I would not invite questions. Thank you.
Thank you, Mrs. Rampersad. As she indicated, there will be a Q&A at the end of the presentations. So I know you all will have a lot of questions, so we look forward to that too. Okay, moving along, we have the representative from PricewaterhouseCoopers. His name is Mr. Sean Ramirez. Mr. Ramirez is partner in PricewaterhouseCoopers and head of the assurance line of service in Trinidad and Tobago firm. Sean has over 20 years experience in audit and related services across all sectors. He has guided the board of directors in many of the country's top organizations to establish effective audit committees to the benefit of these organizations. Sean is a significant contributor to leading practice on the role and responsibility of audit committees and has contributed to PricewaterhouseCoopers Audit Committee's good practices for meeting market expectations, a book which is included in your package. Mr. Ramirez's presentation this evening will deal with audit committee functions. I now invite Mr. Sean Ramirez to the podium. Thank you.
I'd like to acknowledge members of the head table, and if I could please take all other protocols as already having been observed. Good morning to you all. Well, first of all, I'd like to commend the ministry and the organizers of this event for, I think, what seems to be a very relevant program, both from the sense of the context and the timing of it, as well as the various presentations within the program. I think they flowed quite nicely into, for instance, what I have to deliver here today. I also thank them for the opportunity for having PwC make a short presentation here this morning. This morning, I don't think the objective is to make you all audit committee experts, if there's even such a thing. It's really to provide a deeper awareness of the audit committee function, some of the key principles and elements included therein, and maybe to chat a little bit about the common pitfalls of audit committees. Okay, there we go. So what I propose to do is to take us through the primary responsibility of the Audit Committee, some of the local legislative requirements in addition to the State Enterprises Performance Monitoring Manual, take you through some international best practices that have been put out by PwC globally, and as the moderator referred to, there is a publication out at front. I don't know how many of you picked it up on your way in. You can look for it on your way out, which explains all that I will have to say and even more in quite user-friendly language. I know it's been a heavy morning, and I'm sensing a bit of information overload, so you can read it at your leisure. But the primary responsibility of the Audit Committee that we see is to oversee on behalf of the board the integrity of the financial reporting controls and procedures implemented by management to protect the interests of shareholders and all other key stakeholders. This, we think, provides a sound reputation for the state-owned enterprises, provides credibility of financial reports released from the organization, and contributes towards a value for money use of state resources, as commented upon by the minister this morning. I think, it's only so exciting I can make this presentation, so maybe if you could think of it in the context of what can go wrong if some of these things are not in place. And I think there's ample demonstration around now of what can go wrong if there isn't an actively functioning audit committee. All right, so please bear with me. Mr. Rampersad just went into a lot of detail on the State Enterprises Performance Monitoring Manual. And I admit that I wasn't really up to date with all of the prescriptive requirements and guidance in there. It's quite a lot. And on one hand, it makes your job, I think, a little bit easier in that you don't have to think about what you need to produce. But on the other hand, there's a lot to produce and keep up with. All right? In addition to that, what I thought I would do is just outline some of the other key legislation around that probably encourages the use of audit committees, just to show you that it's not only the state enterprises, it's in fact best practice across the board, private and public sector. So for instance, one of the most recent bits of legislation is the Financial Institutions Act of 2008, and within there are very specific requirements for the appointment and composition of the audit committee, as well as the duties that audit committee must function. All right, I'm not going to go into too much detail. In addition to that, I think we could take as somewhat best practice the central bank's guidelines on corporate governance. So it's similar to a lot of the things that Mr. Rampersad just outlined in the Performance Monitoring Manual. Things like ensuring the independence of the firm. In many cases, you will have the Auditor General, but in some cases, you have private firms as your external auditors, reviewing financial statements before recommending to the board for approval, monitoring compliance with policies, laws, regulations, etc. The duties include reviewing potentially adverse transactions. And maybe I could just pause there for a minute. As I said up front, if you think of this in the context of what can go wrong, in many cases, people see the accountants and by extension the audit committee as reviewing historical information after the fact. Some things already gone wrong or gone right, but you're looking at the results after the fact. I think what this concept introduces here is that even when new transactions, new lines of business are being contemplated by management and hopefully being put to the board for approval, that either as the audit committee sits on its own or audit committee members sit as part of the board, that they would take an approach that would consider the potentially adverse implications of the particular transaction or line of business or activity, whatever it is, whether it be from a legal point of view, a financial point of view, a taxation point of view, whatever it is, so not to be the pessimist among the bunch, but really to say what can go wrong. Are we covering all bases? All right? Then there are the more traditional things in terms of ensuring internal and external auditor independence of management, monitoring deficiencies identified, reported, and corrected, ensuring risk management function is independent of your core management and it's comprehensive to the risk of the particular entity. Also, the Companies Act of 1995 also has similar requirements, so I wouldn't go through again, but really stressing the importance of the role of the Audit Committee. What I would focus most of the presentation on is, in fact, what I referred to up front as earlier, the best practices globally. And some of these things, in fact, none of it is really rocket science. You know, it just makes good sense, but I just want to emphasize a few key points this morning for you. So first of all, how should the Audit Committee be organized? All right, we all know the Audit Committee is a committee of the Board of Directors. Well, as any other committee of the board, I would imagine that there should be a written charter which essentially outlines the mandate of that committee. What are the key responsibilities of that committee? Then you need to move to composition. Who should sit on this committee? What should their qualifications be? And I'll go into a bit on that a little later on. There are roles and responsibilities for the chairman of that committee. And then the perceived, because of the nature of the committee and the committee's work, I think there's a need for both in fact and perceived independence of the members of that committee. All right? Also, continuing with the organization, the committee would need to consider how often they meet, when do they meet. These are normally aligned with your key requirements or reporting obligations, depending on the business that you're in. Of course, with any other board or meeting or committee meeting, you would need to ensure that there are high-quality papers circulated sufficiently in advance of the meeting so members can appropriately prepare, that there are sufficient resources and professional advice available. Mr. Marshall mentioned that this morning in the context of the board. So the committee members are not meant to be experts in everything. They're meant to know enough to be dangerous and to sense when they need help. And they need to be given the resources when they need help, whether they be legal resources, accounting resources, actuarial resources. You know, sometimes those do not reside within the committee. In fact, most times they don't, and specialist advice is required. But they need to be given the resources to be able to carry out their mandate. And of course, well, I know many of you would be, you know, in probably still your first year of appointment as board members and possibly committee members. So very important would be an orientation for new members. So what is required of me? What particular training do I need to go through, etc. Am I the appropriate person to be on this committee? Maybe you're asking yourselves. So just to go into a little bit of detail in each of those elements there, not too much. So the Audit Committee's charter, as I mentioned, needs to outline clearly the committee's role, the proposed structure, processes, and the requirements of its membership. These should be reviewed at least annually to ensure that they're still relevant and recommended to the board for approval. So very clearly, it's the board of directors that should approve the Audit Committee charter, the Audit Committee mandate, because at the end of the day, the Audit Committee reports to the board of directors. So what are some of the elements of the Audit Committee charter? The overall purpose and objectives, the organization we spoke about, the meetings, roles and responsibilities. What relationship should it have with management? How often should it interact? What should the interaction be like? Which members of management should it interact with? What should the interaction be with the external and internal auditors? What are the reporting responsibilities either to the board, other stakeholders, in your case, I guess, to the public in any annual reports that are produced? And with anything else, you know, an evaluation of the effectiveness of the committee's function. So at the end of the day, is the committee achieving what it set out to achieve? So composition of the committee, we spoke about independence. The financially knowledgeable people, because at the end of the day, the committee deals with reviewing of financial information, whether it be in financial statements or in some of those reporting requirements to the ministry. So you need to have people who are knowledgeable and able to understand financial statements, and depending on the organization, complex and subjective judgmental areas included in financial reporting. So what are the key things in there that, that members ought to look out for in approving or recommending for approval the financial statements? What are the key estimates? What are the key exposures and the key judgment calls being made by management? This is just repeating something we said earlier on. So the oversight responsibility, getting a little bit more into the financial reporting aspect. So what do we mean by oversight for financial reporting? So as Philip spoke about this morning, ensuring the adequacy and effectiveness of risk management systems and the company's internal controls as they affect financial reporting in particular, but possibly even beyond financial reporting. The adequacy and effectiveness of the system for preparation of financial data reported to the market. And in this case, the committee should also consider, what is the significance of the input by senior members of management not responsible for financial reporting in the preparation of financial statements. All right, so you have a financial reporting unit responsible for preparing the financial statements. How significant is the involvement by the non-financial people? Is there significant influence there that you need to understand? And if so, in what areas? What is the process for monitoring compliance with laws and regulations? Is there a separate compliance department? Is it adequately staffed? What are the key laws and regulations you need to comply with? What is the process of monitoring compliance with internal codes of conduct and concerns raised by employees or others around accounting and auditing matters? So it's one thing for you to review what is put in front of you, but what is most dangerous is what you don't know. And sometimes these come through, non-routine reporting. So there are complaints by other stakeholders. What about this? What about that? Are there appropriate whistleblower avenues in place for that type of reporting? Are they reporting into the appropriate people? What is done with the complaints? Are they logged? Are they filed? Does the audit committee review how they've been dealt with? All right, as I said, it's difficult, but a little bit easier to review what's in front of you, but what's not in front of you but should be there is a lot more difficult to monitor. You heard a lot about risk and risk management and controls this morning. Without going into too much detail, the audit committee need to understand the organization as a whole and the board's attitude and appetite for risk. Because in most organizations, you cannot avoid risk, you will take risk. But the most important thing is how is the risk managed, all right? And what is the appetite for risk? What is appropriate for that particular industry that you're operating in? What is the framework for assessment and management of that risk? And what are the key, really major financial risk exposures to your business, to that business? So where should the emphasis be placed in any risk management system? Because many organizations can produce huge binders of risk management systems and controls, but they may not be managing or addressing the key risks that exist. All right, and what sometimes happens is you get lost in the detail and the key risks remain unmanaged. So I think, a fresh perspective and ability to sit back and assess what are really the key financial risk exposures that should be managed. And similarly, for internal controls, management, as Mr. Marshall outlined this morning, are the ones on the field. They're the ones responsible for establishing the appropriate structure, evaluating the effectiveness of that structure, identifying material weaknesses, and notifying both external and internal auditors as well as the audit committee. So that's what management is responsible for. Of course, they may not always do that because in some cases it may show up a deficiency on their part. And that is where the audit committee members need to remain alert for any weaknesses being reported by other parties, be it the external auditor or internal auditor, all right? Or in cases where there's an independent regulator, what are the weaknesses identified, what are the recommendations made, and how are they being implemented? All right, fraud, something very, very topical. So from fraud risk point of view, what is the audit committee's responsibility? Well, the audit committee, first of all, needs to be aware of what are the particular fraud risks for that entity. And it may be different from entity to entity. All right, whether we're talking about misappropriation of assets or incorrect financial reporting. All right, sometimes, especially in financial institutions, you know, at the stroke of a pen, you know, significant fraud could be created. In other cases, it's theft or misappropriation of physical assets. So you need to understand for your particular entity, what are the key exposures to fraud risk? What is the control culture of the entity? And you know, it's difficult as audit committee members, as board members, to really get a sense of the control culture if you remain on or behind the touch lines, right? So you would need to rely on your interaction with management, but also most likely on your internal auditor, your external auditor, all right? What are the systems and controls implemented by management around fraud risk? And as I said before, assess the recommendations made by others and what are being done to implement them. And in reviewing the financial statements, any other financial information produced by the entity, be alert to indications of fraud. So when things just don't add up, when explanations you know, don't corroborate each other, you know, I'm not saying you need to second guess it every time, but you know, this is where your experience and judgment comes in. You need to remain alerted. I think I may be incorrect, but I will still say that I believe in Trinidad we have a very trusting culture, and nothing is wrong with that at one level, but at the same level, we all have responsibilities to, in terms of managing at our various levels, and we need to remain alert to the risk of fraud. All right, but that is a huge judgmental issue on your part. So getting down right into the financial statements, the responsibilities include reviewing accounting and reporting issues, being alert to any pronouncements in the area. So depending on the accounting framework you follow, whether it's international standards or something else, you know, what are the pronouncements that affect the particular entity that you are an audit committee member of? There's a thing called, you know, adjusted and unadjusted items in the performance of any audit. So again, it's up to materiality. So without getting into too much jargon there, just remain alert to what are the non-adjusted items identified by the auditor. Read the management's letter of representation. So this is management's written representation, in most cases, to the Auditor General or the other private external auditor on the financial reporting and elements of the financial statements. This is part of the audit evidence gathered by the external auditor that enables them to sign off on their report. So what is management telling the auditor that enabling them to sign off on their report that you may or may not be aware of? You know, so a good practice would be to read the letter of representation produced by management and given to the external auditors. There may be only traditional things in there. There may be some specific things inside of there. Again, in keeping with the financial statements review, you need to understand the key accounting policies, whether adequate disclosure has been made, and also if there's an annual report produced, what are the key sections in there in terms of management's assessment of performance and reporting. You know, at the end of the day, I said, you know, the audit committee is primarily responsible for the integrity and the credibility of financial information going out there. So before it gets into the public domain, even before it gets reported to the relevant line ministry or Ministry of Finance or to the public as a whole, you know, you have a duty to ensure it's complete, it's fair, and it's in compliance with the required accounting framework. All right, I think it's a lot better, you know, for any deficiencies to be identified within the organization than from someone outside of the organization in a public forum. I think Mr. Rampasad also spoke about the need to produce interim financial statements as part of the performance monitoring manual. So again, the responsibilities there are the same, but recognizing that you know, it's not your year-end financial statements. it gives the committee a chance to focus on significant issues on a timely basis. If there are issues that require review or research prior to the year end, reviewing the interim financial statements rigorously can help with identifying those issues and giving you a head start. It also improves your understanding of the business of the organization. All right. Oversight over regulatory compliance and ethical matters. Again, the key thing is to review the monitoring systems in place by management. Are they effective? Is anything coming through there? Sometimes a good practice is to have a written report on compliance coming to the audit committee. It's one thing, for management to say either that there's nothing to report, or for there to be no report and the audit committee to assume that there's no non-compliance. But I think sometimes, when someone is asked to put their name and sign to it, you think a little harder about what you're saying. So a good practice may be just to say, well, can we get at each meeting possibly a report on compliance? Are we in compliance with all the key laws and regulations? And if we're out of compliance, what is being done to bring us in compliance and in what time frame? And it then provides a basis for you to follow up on. I know members of management here may not be liking me at this point, but I apologize. As I said, external auditors and internal auditors are two key bodies that the audit committee will be required to work with. And the external auditors, whether in the form of the Auditor General or a private firm, the principles are the same. So the audit committee should be discussing the following: the auditor's service approach. Are they appropriately qualified to do this particular audit? What experience do they have in the industry? Are they independent? And what is their approach to providing the service that you're looking for? What is their assessment of risk and controls of the entity? What is their approach around areas where there may be a breach or deficiency in controls? What are the key financial reporting implications that they need to consider? Any new accounting policies, any new standards being introduced that affect the business significantly? And what are the observations by the external auditors around governance? From their view, even though they come in maybe once a year or twice a year, they bring an independent assessment. And they may have a view of governance that you choose to ignore or act on, but it's always useful to hear their view on governance. So in working with external auditors, there are various stages of the audit that you may want to interact, and this depends on your particular situation. But normally prior to engagement, you want to be understanding the scope of the service, discussing independence, and the particulars of the engagement letter, meaning the terms and conditions of their appointment. Once they've been engaged and they've executed their planning, what is their planned approach? What is their assessment of the audit, and where will focus be made? Is focus being made in the areas you expect it to be made? Maybe you can ask the auditors at that point to pay more attention to other areas that they haven't included. During the audit, very important for those especially who have to comply with reporting in a particular time frame, as Mr. Rampasad outlined, the key here is to avoid surprises. So you don't want to wait till the end of the audit and a week before you're required to report to find out that there's a major issue with the audit. So keeping in touch during the audit, whether verbally or through written reports, is very important. And of course, at the end of the audit, to discuss their findings. Internal audit, similar, but recognizing that internal audit is normally part of the organization, and therefore around more into the bowels of the organization. And in many respects, the internal audit function are the audit committee's ears and eyes on the ground as you stay behind the touchline. So the audit committee meetings are usually attended by internal auditors by invitation. And even outside of the formal meetings, it's good practice to be meeting with the internal auditors. I think in our environment, where it's probably less sophisticated, it's probably a good practice to have a good relationship between the audit committee chairman and the internal auditor, where they can call each other, as frequently as they wish. They could meet, they could speak on the phone as issues arise, or just to touch base. It's always a positive thing to do. Clearly understanding internal audit's activities, the function, the structure, and their resources. All right, do they have enough resources to carry out the mandate that the audit committee is providing to them? The last point there, the head of internal audit should report directly to the committee. Now, you understand why in the context of what I said, why that makes sense. But in practice, I think this causes some friction. I think the internal auditor is an employee at the end of the day, and I think most CEOs would feel that the internal auditor reports to them. So I leave that to be handled on a case-by-case basis. But best practice would be for operational aspects. There's reporting to the CEO. The CEO needs to be aware of what you're doing. I think any determination around where your focus is going to be, what internal audit reviews you're going to do, and maybe even what the result of those reviews are, probably need to be primarily to the audit committee. Of course, with the CEO and other key managers being in the loop. All right, they obviously would be given a chance to provide their responses before the report goes to the audit committee. Okay, we're almost there. The internal audit responsibilities of the committee. So what should the committee do with internal auditors? As I said, review activities, resources, structure, consider their findings and recommendations, looking at implementation, and at the end of the day, assessing their effectiveness over their function. I mean, an internal audit function may have been effective 10 years ago for what they were asked to do then. Do they continue to be effective? I think the internal auditors here would let you know as well that in accordance with the internal audit standards, there's also a requirement for a peer review at least every 5 years. And this assesses the quality of the internal audit function.